Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy. So tonight we're going to talk about net unrealized appreciation, or NUA, and this is a very nuanced conversation. I'll say that I think this is probably, and Andy can correct me as we go, but probably something that is less complicated than people make it out to be, but it is something that has to be done the right way, and something that's high stakes gaming, right? You don't want to do it wrong. So let me introduce Andy. You all have talked to me about, or heard me talk about the Slott Group, as I refer to it, and it's the Elite Advisor, Ed Slott Elite Advisor Group. I think it's a technical name, right, Andy?
Yeah, that's right.
I'm fortunate enough to be part of the Master Elite Advisor Group, which just means I've been there for a little while. It is really a fabulous group of individuals and a fabulous resource. There is about now 450 of us throughout the country, as Andy had just told me, as we were talking before we started this tonight, which I think is great, because you've often heard me get on my soapbox a little bit about this, that I just can't believe that more advisors, CPAs, attorneys aren't involved in this group, because the focus of support and education is really around effective distribution techniques for retirement accounts, retirement planning, and it gets a bit deeper than that. But it is the biggest challenge facing retirees, I believe, today, is how to effectively take these funds that you've saved over time, sometimes significant amounts of funds, spend them for yourself most effectively, and pass them to the next generation, or you're no longer here. So Ed Slott, you probably all have heard of. Ed's been named the best source for IRA advice by the Wall Street Journal, and USA Today writes, it would be tough to find anyone who knows more about IRAs and CPA Slott. But I've got to tell you that Ed can't do it all, and he's got people like Andy Ives, who you're going to hear from tonight, Sarah Brenner, Ian Berger. Am I pronouncing Ian's name right?
He actually goes by Ian, but yeah.
Ian, excuse me. So
Nobody
Ian
gets that
Berger.
right.
And these folks are really the backbone. You know, Andy and I talk often. I talk to Sarah a heck of a lot, and these are the folks that give us the information when I email them and say, hey, I've got this situation, and they write us back with, here's an article we wrote about it, here's the tax code that it refers to, and we're able to share that with CPAs, and the CPAs that are often blown away by the information and appreciate it. Each week you hear me on the webinars, my weekly webinars, we start off with the slide updates, and they are letters that come in from the public or advisors, CPAs, attorneys, with questions for the Slott Group. And Andy is one of the ones who often answers those questions, and they're about effective rollovers. My client did this, how do I correct it? What should I avoid? So distributions, rollovers, 401k contributions. You can just imagine there's every kind of different question that comes in, and these folks handle it. So let me tell you a little bit about Andy. Andy has over 20 years. He's a certified financial planner like myself, he holds the accredited investment fiduciary designation as well. Andy has over 20 years of experience in financial and services industry, with a wide range of duties. Andy was a relationship manager at a mutual fund company and sold short-term or short duration investment products to institutional clients. So that simply means big firms and money managers, I'm assuming, right, Andy? Mm-hmm. And then he worked in the 401k space, and he got his certified financial planner designation in 2008. Mine was 2011. I'll tell you, that was challenging, wasn't it, Andy?
It was a lot as a wholesaler at the time, I would read in my car before meetings. I would read in my car after meetings. It was a couple of years of hard work.
It was, it took me 3 years to study and be ready for that. Yep. And that's an 11 because like you said, you're working the whole time. But that's, at the time, it was an 11-hour, 2-day exam.
Yeah.
And you've got to know everything proficiently, and that's the challenge right there, right?
Yeah, I'm part of that designation. I'm happy with that designation for sure.
Me
I will
too.
not let that slip.
No, no, no. And it's really important. And one of the most important things about that is the CFP board was one of the first ones that said fiduciary rules apply, right? You first got to do what's best for your clients. And the fact that we're still having this conversation, I'm going to try not to get on my soapbox, because I had a whole conversation on Tuesday, yesterday, about this $97 million fine that TIAA CREF got for violating their fiduciary responsibility. I think it's just so important that they're standing behind that and really pushing it. So Andy, welcome tonight. Thanks for being here. We talked a little bit before we get into NUA. We talked a little bit about some of the things coming up on the horizon, and I was supposed to be seeing Andy face to face next month in Kansas City, but because of resurgence of COVID and some restrictions, we're not doing that. Twice a year we have educational events that we're required to attend, and they're day and a half, 2-day events, usually in sometimes fun parts of the country, sometimes a little less fun, I'll say.
Right.
Kansas City kind of falls in the middle there. You know, I think it's interesting. No offense to anybody that's from Kansas City, but there's we were talking about, bigger things on the horizon, and Andy talked about Secure Act 2.0. So I'm going to ask him to give us some updates about what we could expect from the update of the Secure Act, and anything else that just comes to mind that we should be paying attention to, or maybe, talking about with you folks. So Andy, you want to talk about that a little bit?
Yeah, for sure. And thank you for having me join the group here, Mark. I appreciate that. Yeah, some people call it Secure 2.0. Some people call it Son of Secure, but we all know the Secure Act came into effect January 1 of last year. A lot of people were scrambling. A lot of things changed, like the stretch IRA and the new 10-year payout rule. RMDs age was raised to 72. So all kinds of things that were going on. Now, when legislation is written, that's great. We have to interpret it, and then we apply that new legislation. And as we apply that legislation, and as issues come up, oftentimes we recognize that there's some gaps in this legislation, or this wasn't covered in this legislation. So we have to figure out what maybe they were thinking, what do they want to do, and then ultimately we get further guidance that says, yes, this is what we meant, and then we can be sure in how we're applying this legislation.
Right.
What's interesting about Secure 2.0 is that it's not just additional guidance or clarification. It actually says, well, you know what, we didn't have enough information, or didn't change enough things in Secure 2.0 or in the first Secure Act. So I think one of the biggies, and who knows if this stuff is going to happen, this is all proposed legislation, but it's just rumors that we're hearing. So one of the big ones that is just going to confuse people forever is a further increase in the RMD age. So we know that it was 70 and a half. It went to 72. So we had these people that were kind of in the middle. When did they turn 70 and a half? When did they turn 72? Some confusion around that. The rumblings are now is that they might dial it up to 75 in another couple of years. And I've heard even rumblings that maybe after a couple of years after that, they dial it to 78. I know this drives Ed nuts, because he is a big proponent of getting rid of the RMD altogether. If it was up to him, he would say, you worked your entire life for this money. We're not going to force you to take it out. It's going to get taxed eventually. If you don't take it out now and you pass away, it's going to go to your beneficiaries, and they're going to have to pay the tax on it. So why you have to take out the RMD befuddles him. So who knows? Maybe they'll waive it at some point in the future. But for now, we're looking at possible staggered increases in the age. So that'll be job security for all the financial advisors out there.
Yeah.
Most of the other things on there were just kind of little things like dialing up IRA cash-up contributions for people that are older. There's a 50 and older right now. So a lot of little nickel and dime things that they're going to add into that supposedly. But the big one is the RMD age. Hopefully we'll get some guidance on trust. There's some things on there about trust. Like if you have a trust as your beneficiary, there's some confusion as far as how certain trusts work. And if you have a particular beneficiary of that trust, like a special needs trust, there's some confusion out there around that. But Time will tell. I wouldn't lose sleep over anything once that gets passed. We thought it might get passed in the summertime, but things are getting delayed and delayed and delayed. And now we're thinking maybe early part of next year. They might do like they did with Secure. I think they passed it a week before the end of the year. So I remember I was on Christmas vacation and Ed was calling me, my phone was ringing because we had to write and create all this material to get it out before the Secure Act became effective on January 1. So in this line of work, you never know what's going to happen. So maybe it'll pass the last week of the year. But yeah, from a Secure 2.0 standpoint, I think that would be the biggest update would be the possible age increase on RMDs.
So just for everyone's benefit, RMDs are required minimum distributions, and that's a certain amount, a set amount that the IRS requires that you take after you reach a certain age. So as Andy said, it was prior to the Secure Act, it was 70 and a half, the year you turn 70 and a half, and now it's age 72. And it's a little more in depth than that in your first year, but that's a required minimum distribution.
Yeah, I apologize for the acronyms.
It's okay.
I throw them out there. I know I've done some webinars with Ed with we'll have 1,000 CPAs on there, and he says, "All right, it's a drinking game. Every acronym I say, take a drink." So he gets excited about that, but it's ridiculous the different acronyms in this business.
Yeah, no, that's okay. Well, we're here talking about NUA, right? So. So let's just go back to the Secure Act for a second, because a big one that I talked about throughout the year and that you folks helped us with was the 10-year rule, right?
Yeah,
so If any of you folks attended my classes over the past several years before the Secure Act, I would say, we've got this great tool called the Stretch IRA. It's what we call it. There's really no actual Stretch IRA, but it allows you to pass funds to the next generation, and that generation, as long as it's done right, can take distributions over their lifetime. But I always used to say that's going to go away. That is going to go away. Well, here we are, and that went away with the Secure Act. And now they say that we've got to distribute those funds within 10 years. And all of us, right, when we got together and thought, okay, this is like what they call the 5-year rule. All has to be distributed by the end of 10 years. And then I'm going to let you tell the story of what happened.
Well, that's exactly right. So there's a small group of people that can still stretch payments. So you got a spouse, disabled person, chronically ill person that's not more than 10 years younger. So a small group of people that can still stretch payments. A minor up until their age of majority. That's it. Anybody else, you're stuck with the 10-year rule.
Right.
So the 10-year rule is you have, like Mark said, you have to empty the account. There's no annual required minimum distributions over that 10-year, but at the end of the 10-year period, you got to have the whole thing out. So technically, the last payment is the one big RMD. So that's the way we all interpreted it. That's how all the IRA experts out there interpreted it, and that's how we were sharing the information. We did it for probably 6 months. But then the IRS, I think that's what you're referring to, publication 598 came out. And it was almost like the IRS, when they updated this document, it's the big 60-page document that says how IRAs work. It's almost like they just cut and pasted and they took out a date and put in a new date, and they didn't read any of the material. So they had old examples in there. And they had one example which said that there were RMDs during the 10-year period. And then the entire industry was up in arms. They say, what the heck are you talking about? This IRS publication, which is supposed to be super clear, explain how we do things now, says that there's annual RMDs on this thing. A couple weeks later, lo and behold, it was like on a Friday afternoon, IRS sends out this quiet publication, a little bit of an update there, no big announcement. The correction was in there, and everybody was able to take a big sigh of relief. But that's how it works with this legislation. There's so many questions about things. It takes time for the facts to be realized, and for people to, yes, this is how we do it. This is the process of how we do the 10-year rule. This is how we do inherited accounts. This is how we do RMDs. This is how we do trusts as beneficiaries. So it's funny. I was mentioning it to Mark. I said a lot of times the legislation will come out. It'll be somewhat vague, and then like Ed and the other experts out there, we will interpret it. We will figure out what is the best course of action. That information will get spread out to the financial advisor community. The advisor community then implements what the experts have interpreted the law to be. And then after that, the IRS says, oh yeah, that's what we meant. And then they clarify it with their final guidance, which is kind of funny, but I guess that's how it works sometimes with some of these laws.
Yeah, and I can't emphasize enough the material the amount of material that we go over at these training events. So again, I'll be sitting here at my desk at this training event, and there'll be PDF books instead of the regular books, but these books are this thick, like inches thick. You've got one. Yeah.
This is our 2-day training manual. This is our virtual manual for, I've got a meeting coming up in a couple of weeks. 400 pages is what's in it, 440 pages, I think. We will literally go through that page by page by page. Now, it's not that boring. We spice it up a little bit with good stories, but it's literally what I think is probably a 2.5 page thick manual. All IRA, retirement plan, tons of information. Crazy.
Tons of information that's updated from 6 months ago, right? So this is it has to be timely, and this is where I get so crazy about. There's only 450 of us in the entire country that spend the time to do this, and the expense, frankly, of it. But it's just so important. Okay, so before we move on, I didn't do this earlier. I'm just going to do a sound check. Just raise your hand if you can hear us. Okay.
I hope so.
Yep. Okay. Well, we've got plenty of people. I usually ask, but I just wanted to make sure. Yeah. Okay. We do have a question. So before we get into NUA, I'm going to pause and have this question answered. And this is from Roseanne. Hey, Roseanne, how are you? If a minor child inherits the IRA and is exempt from 10-year required RMD rule, when he or she reaches the age of majority, does he or she now have a specified number of years in which to withdraw RMDs from the account? That's a really, really great question. So Andy, I'm going to let you handle that.
Yeah. So basically the question is, if a minor inherits an account and they are truly a minor, let's say I'm a 6-year-old inherits an account from their parent. Yeah, that child is a minor. That child can stretch payments. Basically, you would look up I would go to my single life expectancy chart, which I have over here, and I would look up a 6-year-old, and the stretch is 76 years. So that child could stretch based, their required minimum distribution would be based on 76.7 years. Now, they would be allowed to do that stretch payment until the age of majority, which is typically to age 18. So if a 6-year-old were to inherit, they would be able to stretch payments for 12 years. Then the 10-year rule would kick in. And then they would basically switch from stretching payments to a 10-year window, no annual RMDs during the 10-year window, but they would have to empty it out by the time they were basically 28.
Mm-hmm. And this applies for traditional IRAs and Roth IRAs.
Same.
Yes.
Same. And it's got to be, here's where people get tripped up on that. It's a minor child of the parent account owner. So we see people that are their grandparents and they say, I'm going to leave this to my minor grandchild. No, that will not work. It's got to be a minor child of the owner.
Yeah.
So if it was a grandparent that left their IRA to that 6-year-old, the 10-year rule would apply immediately. The 6-year-old would not be considered what's called an eligible designated beneficiary. They would have to do the 10-year rule from the time they were 6.
So that you were reading Roseanne's mind, because that was her follow-up question was, is it the same as the child inheritance from a grandparent?
Yeah, there you go. Yeah, that's typical. Good question, because that comes up quite a bit.
Yeah, really great question. All right, so let's talk about NUA. So NUA, we were talking about it a bit before everybody started joining us. So this is net unrealized appreciation. And I'll give you an example. I was talking to a friend who had asked me about taking over his accounts. And he said, well, I rolled him over to this firm, when I retired 6 or 7 years ago at the time. And he was telling me about where he worked, and he had about, I guess, the total rollover of about $3 million, and over $1 million of that was in company stock. And so as we're talking about it, I said to him, well, what'd you do with that company stock? He said, well, we just rolled it over to the 401k. And I said, well, that's unfortunate that you missed a potential opportunity there. And I explained to him the benefits of NUA, and I'm going to let Andy kind of start there. But this is something that happens all the time. And unfortunately, it's not something that can be undone. This person missed a significant, we did the math for him because he asked me to. I almost didn't want to, right? But we did the math for him. This person missed a significant tax saving opportunity. I think it was to the tune of about $60,000 to $65,000. which I think is a lot. Maybe you folks don't think that's a lot of money. I think it's a lot of money. But so Andy, let's maybe that's a good intro to what is NUA and how does it work.
Yeah, well, I mean, that's a great intro. And actually, you were talking about, being CFP, Certified Financial Planners, and the fiduciary responsibility, and doing what's best for the client. I mean, that's in my core. That's kind of like why I do what I do now. I like helping people. But there's a lot of people out there that don't do it that way. And that's why we've had all these regulations out there. And probably within the last year and a half was the SEC came out with regulation BI, Reg BI for best interest. And that was about, you have to do stuff that is in the best interest of your client. And interestingly enough, within that document, the word rollover was used 87 times, which means that the SEC is keeping a big eye on rollovers, because they're probably getting tons of complaints from people about rollovers that were mishandled, opportunities were missed out. You've got to have certain conversations and questions before any rollover is done. And NUA, asking the question about NUA, as Mark and I were talking about, should be asked on every single rollover opportunity. It might not fit, but it should be, that question should be asked. And then you could, if it doesn't work, you move on, you check the box. We talked about that. Sometimes it makes sense to keep money in a 401k plan and not roll it over. Maybe a person has life insurance in their 401k. Maybe they can't get life insurance anywhere else, and you can't hold life insurance in an IRA. So it might not make sense to take that life insurance out of the plan. Maybe they don't have the money to pay for it, to buy the policy out. So that might be a reason to keep money in a plan. Maybe there's an investment that Mark has access to in an IRA that a person can't get access to in a 401k. So they've gone through the different questions, and you know what? It makes sense to move the money from the plan to the IRA. A third option, maybe it makes sense to take money out of the plan now and pay tax now. And that is the NUA, net unrealized appreciation opportunity. It doesn't fit for everybody, but ultimately what it is, the big picture is, if you have a chunk of money in a company stock in your 401k, and if you don't pursue the NUA strategy, and you either take it out or you just roll to an IRA and take it out, ultimately you're going to pay ordinary income on all that money. So in Mark's client's example, he had $1 million. Ultimately, when that money comes out of his IRA, after he rolled it over too quickly, he's going to pay ordinary income on the $1 million. Had he pursued the NUA strategy, let's say hypothetically that of that million, let's say 200,000 of it was the basis, and 800,000 was the growth, the appreciation. The NUA strategy allows you to pay ordinary income only on the $200,000 in basis, and then capital gains on that growth. So in that example, 800 grand. So Mark talked about the $60,000 in tax differential. This person paid ordinary income on $1 million, whereas they could have carved off whatever the difference was between their tax bracket and whatever they would have paid for the capital gains. That's the $60,000 in savings that was lost because they did not pursue the NUA strategy, so to speak.
And for you math folks out there who are typing your question right now, when I did my analysis, I had to include some growth because it had been some time, and the continued growth and what that tax rate is going to be over time. So
that makes sense. Totally makes sense.
I've got a couple mathematics PhDs out there that I just know we're going to say, well, wait a minute, that doesn't. But
well, it accrues. There is some big NUA opportunities out there, and I cringe when I see people moving too quickly. There's so many ways to get sideways, and we'll talk about that. Things you can't do because, as Mark said, it is super strict. You have very tight boundaries and guardrails on NUA, and if you bounce outside of them, you can blow the whole thing up. And as he said earlier, it's not super difficult. The transaction itself and the strategy itself is not super convoluted, but you just have to make sure you follow the rules.
Yeah, so, I'll give you another example, and I'm dealing with it right now, and I'm not sure if she's on the call or not, but of course won't mention names, but I have a widow, a very recent widow I'm working with, and the 401k provider is, in my opinion, pushing her to roll over her IRA to somebody either they're friendly with or I don't know what the relation is there, right? But I keep advising her just do nothing right now until we look at because I don't know what's in the 401k. I don't know if it's best for her to roll it into her own name, to keep it as an inherited IRA. We haven't looked at all these, but once you do it, because folks talk about expediency or just get it done, there's no reason for that, right? I mean, there's some timeline that you have to handle, but as far as naming beneficiaries and things like that, but listen, and I learned this from Ed, just first do nothing because you can't undo it. The advice might be sound, but we're within 45 days of this fellow passing away. No reason this has to be done right now. And it's certainly without all the information. And I'm not suggesting this is the case, but remember, we were talking about TIAA Craft. I don't remember if that was before we started or after, but TIAA Craft was fined $97 million. TIAA Craft bills themselves with this big benevolent organization, who does things low cost, sometimes free and in the client's best interest. And the SEC found that wasn't the case, and they were pushing people into high cost, high fee platforms that they have and incentivizing their financial advisors to push clients into that. So listen, it's not always in your best interest, and you've got to make sure you step back and you get knowledgeable advice and look at everything, because you can have big mistakes, and the IRS is not very forgiving with most things.
Yeah, for sure. They the rules they're very strict. The rules are the rules, and they're going to say, oh, we'll let that one go. No, the rule is this. You did this. You don't get relief from that. That's the bottom line. So unless there was some circumstance that you had no control over, we have seen people get some corrective services from the IRS, but it's because they didn't do something wrong. Somebody else did something wrong. That's right. And that's probably where that 97 million fine came from, because somebody else was doing something wrong and the client wasn't doing the wrong thing. But yeah, so we'll talk about, like I said, I got a couple of slides. Like Mark said, I got a couple of slides. We'll talk about the guardrails. If you have company stock in your 401k that has not yet been rolled over, or if you know someone who does, as exactly what Mark said, just pump the brakes, learn about NUA and how this strategy works. Again, it's not super complicated. You just got to follow the rules. And then you can figure it out. If someone knows NUA like Mark, you can say, yep, this makes sense, or this doesn't make sense. And there's a tipping point. I call it the art of NUA, because yeah, you can do the math, but for some people, this math might make sense. For some people, it might not make sense. So that's the art, is finding the tipping point of where the NUA strategy makes sense.
That's right. Before we share your slides, I'm just going to give folks some reference where they can find some of the slot material, and the slides that Andy is, and there's also a sheet. I think the sheet is probably something I'm going to upload. We're going to see about the slides, because they may not be beneficial without the context.
I think the sheet might be the best.
Yeah. So let me share my website just quickly. So raise your hand if you can see the Attleboro Wealth Management website for me. I'm just going to direct you.
There it is.
Okay, so you'll see here, you've got these menus on the top, and this is what I was talking about, this events and webinars. So you'll see our weekly webinars are here, and you can go in and if you're missing me for some reason and you really want to hear me talk, you can go through and listen to these. Our special webinars are right here under that, and you'll see Andy's face in there at some point. We've had some attorneys in there, David McKnight, that all of you are aware of. Ed's down there as well. And then I have this slot corner that we built out, because there's so much great information. So there's me and Ed. There's Ed again on video. There's a couple bits about why it's so important to be part of the slot group, and some other video. But down here are the charts that I get from Ed's group that I make available to you. So you can download these here, right? So these are all copyrighted by Ed and his group. And these things that Andy's talking about right now with ordinary income, right? If you're married filing jointly, these are the ordinary income tax brackets, they're called, or referred to as. If you're filing single, it's over here. And Andy's talking about capital gains. So if probably the average person probably pays about 15% capital gain. You got to be aware of this 3.8% Medicare surtax as well. But you'll see that that's pretty low on the scale of this marginal tax rate. So keep that in mind while Andy's talking about these things. And you can download these charts. There's quite a few on here, and we'll make the Andy's NUA document available as well. And here's that uniform lifetime table that Andy referred to for required minimum distribution. So that's on the second page of this, and you would have to download that there. All right. Any questions about that before I move on?
All good stuff. And those I get shivers when I see those charts because I have to update those every year.
Okay.
We reread them 100 times to make sure they are perfect before they go out. So
Well,
yeah, those are.
they're listen, like I said, I refer to them, I keep them on the counter in my my conference table at the office, and I have them in my desk here because even this retirement plan contribution, I know what these contribution rates are.
I got it on my desk. There it is right there.
I refer to them all the time because sometimes my brain still goes back to, $15,000. Well, I don't even know when that was, right? But I always double check and refer to these, especially the phase out levels, because you'll see these increase every year as they should, and I hope they continue to. But yeah, these are great things just to have. So you can download these and have them for yourselves, folks. So. All right, so I'm going to stop that share and I'm going to bring up Andy's presentation here. Now, everyone should see something now that reads Net Unrealized Appreciation, or NUA. Yep. And raise your hand, please, for me if you see that. Great, thank you, Ken. Okay, thank you, Andy.
So yeah, so we'll just talk through NUA. We talked about what it is, but then what are those guardrails? What has to be, what hurdles do we have to get over to make sure that this fits? So it says right there, that first sentence is just what I said. What is the ultimate benefit? Upon distribution of NUA stock from a plan, you pay ordinary income tax on the basis and long-term capital gains on the appreciation whenever you sell it. And we'll talk about that in a little bit as well. So the mechanics of that transaction. So you have your 401k and you've got your company stock in the 401k, and maybe you got some other things in there, mutual funds or cash, what have you. The first box on the left, stock can be withdrawn in kind and transferred to a non-qualified brokerage account. So that's the distribution of the stock. You've got the company stock in the 401k, and then the 401k plan is notified. They say, okay, this participant has chosen to do an NUA transaction. And what they do is they take that company stock and they will transfer it, journal it, however they move it, and they will send it basically to a regular brokerage account. So it has nothing to do with an IRA. That transfer of the stock is the taxable distribution. You've paid that out. And then right there it says in the middle, ordinary income tax is paid only on the original cost of the shares in the plan. So getting back to the example we talked about earlier, you've got $1 million in company stock. They send all those shares, the $1 million in shares, to your regular brokerage account. In the example we used before, $200,000 of that was the basis, the cost basis of what you had paid for it. You are now going to be taxed on 200 grand of ordinary income for that year. And then that last box on the right, NUA, the appreciation, so the 800,000 is only taxable when the stock is sold. You could sell it the next day after that transfer if you wanted to. It would be long-term capital gains on that appreciation. Most people aren't going to want to sell it. So we use that example we just showed. You're going to sell 800 grand worth. That's going to really crank up the taxes. Most people will do the NUA transaction. They'll pay the ordinary income tax on the 200 grand in that example whenever they do their taxes. And then over time, they will gradually, if they need some more money, maybe sell off a couple of shares here, a couple of shares there, and they will mitigate that tax by only bringing up the capital gains to a certain level. So now here's what's interesting.
We should know, Andy,
yeah,
I mentioned 15%, but capital gains can be at zero.
They can be.
They can be. So it's possible, depending on what your income, some people retire and they have very little income. Maybe they retire, at 65 years old. They don't have to take their required minimum distributions. They're living off of some of their savings, and it depends on what they have as far as capital gains and other things, but it can be at zero. So yeah. This could be, I think it's challenging, but it could be a way to get funds out.
Maybe they got all their money in a Roth IRA. They can take distributions out of that tax-free. That's not going to mess up any of their taxable accounts, and they can take out a little bit at a time. And you're right, it's challenged, but you can get there. Now, at the bottom of the slide, this is guardrail number 1. And I think I might do that in future slides, is start labeling these things as different guardrails. So the NUA stock withdrawn must be part of a lump sum distribution. Any remaining planned funds must be paid out, rolled over, or converted to a Roth IRA. So what that means is this. If I've got that 401k with $1 million in stock in it, and I've got some other things in there, maybe a couple of mutual funds and some cash, I've got to empty out the entire 401k plan. So the company stock will shoot over to, I don't know if you're trying to share that that slide there, Mark. It popped up.
I'm sorry. Did it change?
Yeah, it changed. There you go.
My
So the company stock will go to that brokerage account, the regular brokerage account like we talked about. Everything else in the 401k will typically go to an IRA. So that gets rolled to an IRA. The funds, the cash, you probably sell the funds, and that check goes to the IRA. That's a non-taxable event. So stock goes to a regular brokerage account, everything else goes to an IRA, and that leaves the 401k empty. And also you can't put more money back into that 401k. That's a little minor guardrail as well. Typically people have left the company, they're not working there anymore, and they're emptying out the account anyways. So they roll everything to the IRA, stock goes to the regular brokerage account, and they're good to go. But that's important. It's got to be a lump sum distribution. So that's an important guardrail. We're gonna have some more guardrails that we're gonna talk about here as well. So if you could click to the next slide, Mark, that is gonna be just basically a diagram, I think, of what comes up next. There it is. So that is a line graph, I guess was what you call it. I'm not sure what kind of graph that is, but that shows the company plan on the left. You got a trigger event, which I'll talk about here in a minute. And the gold boxes across the top, that is what the company stock does. Highly appreciated company stock, pay the tax on the original cost basis, and that goes to a non-qualified brokerage account. The remaining funds in the plan, the mutual funds, the cash, whatever, you've got a couple of options there. The middle row there, it says delay tax. So you do a rollover, send it to an IRA. Or if you wanted to, the bottom one there, pay income tax. You could take that rollover money, you could put it right into a Roth IRA. That would be a conversion. Or you can just keep it, cash it out. So you have all the flexibility in the world as far as what you want to do with those funds that are not the company stock. Like I said, most people will roll them to an IRA, so they don't have to pay tax on it. But if you wanted to keep them out, you could certainly keep that money and go buy a boat or something, or you could do a Roth conversion, and that would be a taxable event as well. But bottom line is, you got to get the company stock out into a regular brokerage account, and then get everything else out either into an IRA, pay to yourself, but it's got to be out of the 401k plan.
Did you mention the time? Did you mention the timeline on that?
Haven't gotten there yet,
Okay.
but I will say it. I'll say it. Got to be done in 1 calendar year. So that's another guardrail, and we'll talk about that as well. If you start an NUA transaction in December, you are going to screw it up, because it will never get done before the end of the year. And if you don't get it done by the end of the year, you lose the entire tax strategy. So we say, if you haven't started it by Thanksgiving, wait until the next year. So it's a lump sum distribution. We know exactly where the funds have to go. It's got to be done in 1 calendar year. So the earlier, the better to start it. If you think you're getting late in the end of the year and you're starting to get nervous about timing, pump the brakes. Like Mark said, do nothing, wait till January. Now, you might not have that opportunity, and I'll talk about that here as well, but typically you just wait till the next year and then go ahead and do your NUA transaction. So next slide. Not everybody is eligible to do this. I mean, I can't walk into my 401k and say, all right, I want NUA. You've got to have highly appreciated company stock, number one, obviously, but then you got to hit a triggering event. And here are the trigger events for eligibility. Age 59 and a half. You hit 59 and a half, the light goes on, NUA is available to you, assuming you have highly appreciated company stock in your plan. Separation from service, not for the self-employed. So those are two biggies. Most people are going to hit age 59 and a half. Most people will someday separate from service. So there's two opportunities right there for people to have access to the NUA strategy. Then we have disability, which is only for the self-employed. So that's not going to hit everybody. And then sadly, everybody's going to have that third option as well, death. So your beneficiaries could possibly do NUA. But anyways, these trigger events are key. You have to hit a trigger event to be able to do NUA. Well, people say, well, I was 50 years old when I left my company. Can I do NUA? Did you separate from service? Yes, you did. You can do NUA. So you don't have to be 59 and a half. You can do it earlier. Then there's some things you have to weigh there as far as different penalties of taking money out earlier, but it's not 59 and a half or older. You got to hit one of those, not all of them or two of them. You got to hit one to qualify.
Great. Great.
Now, that next bullet point says trigger is activated once any distribution is made after the trigger. So what that means is this. Let's say I have a 401k with a nice chunk of company stock in it, and I turn 59 and a half. My NUA light goes on. It's on and it will stay on in perpetuity until I take a distribution. So I turn 59 and a half, my light goes on. I don't do anything. I take no transactions, no transactions in my 401k. I turn 60, 61, 62, still working at the company. My NUA light is still on. At 62, I say, you know what? I'm going to take out 10 grand from my plan, take the company on, take the family on vacation. We go on vacation. As soon as I take that distribution, my NUA light starts to flash. And when it starts to flash, it says, you need to do NUA this calendar year, or you will lose your 59 and a half trigger. So once you take a distribution, it's activated and you got to go now. You have that 1 calendar year to get NUA done. If I take a $10,000 or $12,000 or any distribution, if I do an in-plan Roth conversion, so I do some kind of activity in my plan, I have activated that NUA after my trigger, the light is flashing. And if nobody tells me about NUA, if I am not aware of how it works and the calendar clicks to January 1 of the next year, my NUA light goes off and I have forever lost that 59 and a half trigger. It's gone. Not the end of the world. I find out, I meet Mark, I say, I've got this plan, I'm a prospect. He says, yeah, you screwed up with this one. I say, all right, I'm gonna sign with you because Mark just told me that, hey, all is not lost. You have another trigger coming up here because you're gonna retire in a couple of years. So let's say I'm 65 and now I separate from service. My NUA light goes back on. That separate from service trigger is now activated and I'm right back in the driver's seat with the ability to do NUA. Once again, that light will stay on. So now I'm 65, the light stays on. I do nothing. I still work, or I've separated from service, but I don't do anything. I make no transactions in my account. It just sits there. But now I turn 72. What happens at age 72? We talked about it earlier. I've got a required minimum distribution. The plan automatically sends me my required minimum distribution. That trigger light is activated again because it has another distribution. Now I got to go again. Got to get my NUA done. If I miss that one, I'm out of luck. Then I'm looking at death as my last trigger. And as it says in that last bullet point, once again, got to be a lump sum distribution. So trigger event is an absolute important guardrail, bullet point, hurdle, whatever. You got to hit it. And it's got to be done in 1 calendar year, especially if you've activated that trigger with some sort of distribution or in-plan Roth conversion. Any comments you want to say on that, Mark?
No, that's a really, really great description, I think. You know, these triggering events can be confusing. I love the description you did about the light and the flashing light. I don't know if I've heard you say that before, but you know, it's resonating with me now.
Good.
Because a lot of people miss this, and you're right. I've had this conversation. Well, you know, you missed it at 59 and a half, and people take withdrawals out of their or out of their 401ks while they're still working, if they're you know, after 59 and a half for various reasons. They'll roll over a part of it. They'll do, you know, they'll spend it, or they'll do whatever, you know, different things. And it is really a shame if you have to have that conversation where you say, well, you're out of options, but your heirs can still do, right?
Yeah.
And just to reiterate that, I know you said it a couple of times, but this last bullet point must be a lump sum distribution in 1 calendar year. Doesn't mean that the IRA or the 401k has to come out into a taxable event. The remaining balance of that 401k can move to, and that's what most people do. Most people roll it over directly to an IRA, and then you can figure out your own conversion distribution schedule, what have you. That's where the tax planning is very, very important. You don't want to make the mistake of distributing the entire thing
right
in a taxable distribution an entire year. And listen, I have another example of a client, or not a client, but a prospective client who came to us and found me through Ed Slott's website. And the husband was retiring from, we have a lot of large pharmaceutical companies around us. So a lot of these folks have highly appreciated pharmaceutical stock in their plan. And this person was convinced he found his financial planner and the money manager who was going to handle his distribution. And but the wife had watched Dad on PBS and said, "Let's go meet with Mark just to make sure that we're not missing anything." And there were all kinds of problems with their NUA strategy. I'm not certain if they would have been detrimental. And actually, I was looking for an example I was looking for a chart on J&J. J&J has had a significant drop, but the reason I say that is that he was stuck on this idea that, well, they're telling me that I can do that, the NUA distribution, and then I have to hold that stock for a year, and then I can distribute it at long-term capital gains. And you and I know that's just not true.
I'm going to cover that next. Yeah, you don't have to.
Unfortunately, I couldn't have convinced them of that. So I don't have J&J stock in front of me, and this is not a recommendation to buy, sell, or hold J&J. It is just as an example. But J&J had a very difficult time, and they dropped significantly. So this individual was holding J&J during that time as an example because of poor advice saying you must hold it during that time. Then that's problematic for them, right? So,
yeah, it is. And we'll talk about that. I think that we talk about that in the next slide as far as holding period. What about appreciation after the distribution, after the lump sum distribution? That question comes up a lot.
Yes.
I've got a couple different things I think on the next slide, but yeah, that's so we got the guardrail of the lump sum distribution. We got the guardrail of the trigger that you got to hit before you can do it. So this is actually that example is just what we've been talking about. Ironically, you use the same number. So $1 million in a 401k account balance, 200 in cash and funds, 800 in company stock. This was a little bit different than the example we had. So we know exactly how this works. So we have $1 million 401k account balance, the $200,000 in cash or funds. What does that do? It can get rolled over to an IRA, be taken out if you want to take it out. And then we've got 800 grand in company stock, of which 100,000 is basis. So what happens with that? We know all 800 grand in this example can go to a regular brokerage account. Person would pay tax on the 100 grand as ordinary income. And then the 700,000 in this example would be long-term capital gains whenever they sold it. But this is a good transition into the additional rules. And I could talk all day long on these 5 little bullet points, but a couple of things. All is not lost if first trigger is missed. We talked about that. The person hit the 15.5, blew it, but then hit another trigger. So the light came back on. And I'm glad you like that light analogy, because that in the NUA sheet that you said you had access to, it's all about the lights. That's how I would always try to explain it to people. And when I thought about NUA, I thought about the light bulb coming on. I used to try and diagram it in the air with my hands. I said, I need to put this on a piece of paper. So that's where that chart came from, was the NUA light coming on, NUA light going off, flashing, etc. The second bullet point is appreciation after distribution, holding period for short-term versus long-term. So I have, subsequent to this presentation, have built another slide, and in this section I searched the internet far and wide, and I found a perfect picture of a parfait, a 3-layer parfait clip art, and I call it the NUA parfait. And if you picture the NUA tax as a 3-layer parfait, it should be clear in your mind. So the first layer is the ordinary income. That's the basis that you're paying tax on. The next layer of the parfait is the appreciation. The appreciation in the plan, the NUA, when it came out, that's what you're going to pay the long-term capital gains on. But then you've got the third layer of that parfait, which is appreciation after the distribution. So let's look at this example that we have here on the top of this page. In this case, just at the NUA, this person had $800,000 in company stock, $100,000 basis, $700,000 appreciation. They do their NUA transaction. The 800 grand goes into the regular brokerage account. They know they've locked in $100,000 of ordinary income on the basis. They know they've locked in $700,000 of capital gains. Let's say 4 months later, that $800,000 is now worth $900,000. So they've got another 100 grand of appreciation after it came out of the 401k. What is the tax rules with that? We know the ordinary income on the basis. We know the long-term capital gains on the $700,000 of appreciation. The 100 grand, that stock would have to be held for 1 year for that 100 grand to be considered long-term capital gains. So if they sold out quickly and they had 100 grand of appreciation, that third layer of the NUA parfait, it would be considered short-term or ordinary income. So in a perfect world, a person would do their NUA transaction. They would wait a year if they got a whole bunch of appreciation after the distribution date from the plan. And then after 1 year, they would lock in not only long-term capital gains on the NUA portion, the appreciation that happened in the plan, but any appreciation after the lump sum distribution would also be locked in at long-term capital gains. So that's the 3-layer NUA parfait: ordinary income, NUA as long-term capital gains, and then appreciation. That's got to be held for 1 year.
Yeah, and of course, the downside of that is what I just talked about, where you have a volatile stock, where if you have a drop in that, you're obviously going to pay less tax, but you also have a loss of diversification at a lower tax rate, right? With that,
and you made a good point, because that person was told that they had to hold the stock for a year. Right. The person that told them that basically gave them half the story.
That's right.
And that's what we see a lot. People say, well, I was told this. Well, yeah, that's right, if this. But right. You're this. So yes. Yeah, that person was only, that answer was only applicable to the top layer of the parfait. It was not applicable to the middle layer.
Yeah, and I got to tell you that most people and certainly in this example, if someone came to me and they had $100 or $1 million in a total 401k balance, $200,000 in cash and other funds, and $800,000 in company stock, their primary objective, and probably mine for them, is going to be to winnow down that company stock to reduce volatility, right?
Fair enough.
And risk. So yeah, I think it's a really great opportunity for that too.
There you go. That's the art of NUA. You don't have to do, and this is, I'm going to jump to the 4th bullet point, can do a partial NUA transaction. You don't have to, it's not all or nothing with NUA, you know? And this person, let's talk about someone that has, well, I guess I'll use the same example. Person says, I cannot afford the extra $100,000 of income on that basis. I can't do it. I can do 50, but I can't afford that. Well, how about this then? Let's cut it in half. Let's take half of your company stock, and we'll do an NUA transaction with that. That way you're only locking in $50,000 of ordinary income on that basis. And the rest of that NUA stock is going to get rolled over to the IRA with all those other assets. Now you are sacrificing the NUA strategy on that money that's rolled over. You'll never be able to do NUA on that stock again, but at least you're doing some tax planning. Or maybe, like Mark said, he's going to winnow down that stock. We're going to sell half of it now, so you don't have overexposure to this one company, and then we'll do NUA with the remaining shares on that account. So that is the art and the science, the art versus the science of NUA.
Yeah, great.
So yeah, and I think the last, I skipped the point on here. Can't roll over, the 3rd bullet point, can't roll over NUA stock or tax benefit will be lost. Some people will think that, all right, I'm going to beat the system. I'm going to send all my non-company stock into my IRA. I'm going to do an NUA transaction. They're going to send me my shares into my regular brokerage account. And then within 60 days, I'm going to get the tax break on that. I'm going to slide that money over into my IRA as a rollover. No deal. Can't do it. That'll basically destroy the entire NUA transaction. So we've seen people try to do that. We've seen people start transactions too late in the year. The NUA distribution doesn't happen until January. They miss that. Here's one. Person does an NUA transaction. Everything is great. And then they've emptied the plan. The lump sum distribution is out. They're not allowed to participate anymore. And then maybe a dividend or an interest payment hits in January. Does that destroy the entire NUA transaction? It does not. It does not. They're allowed, anything that trickles in later in the year to the plan can just be sent out. I had a call a week or so ago, a person that had a whole bunch of McDonald's stock, It was a great NUA opportunity. This person had hit 59.5 trigger. I think they had separated from service, so they already hit these 2 triggers. They hadn't done anything in their account, but they had been taking the dividend. So the dividend payment that McDonald's paid in the 401k was paid out to them every time it paid. So the question was, will taking that dividend destroy my NUA transaction? And it will not. So there's some leeway there. If you're just taking the dividend, that's a distribution. But if it's just a dividend off the company stock, that will not ruin the possibility for NUA. So a bunch of little nuances that you have when you do the NUA.
And that's interesting. I didn't know that about the dividend. And here's something else I don't know the answer to. What about privately held companies? What about Wawa is a big company here where we live, and that's not publicly traded.
Yep.
And a lot of executives have a lot of Wawa stock for a lot of money in it.
Yeah, you can do NUA with privately held companies. You can do NUA, like if some people get worried, like if there's a spinoff. My company, I was working for this company for 20 years and they spun me off into a whole new company. Yeah, you can do it. The NUA will recognize that stock as, your existing shares, your existing cost basis, that will carry over. So you can do that. ESOPs, I've seen ESOPs, you can do an NUA with a certain ESOPs plan. They have a little bit of an interesting tweak to them. Some of them will do it normally, they'll send the shares. Some of them will say you have to sell the shares back to the company. So, well, how do you do NUA with that? They will basically do like an in-kind distribution of the shares, and then once they're out of the account for 1 second, they're all sold back to the company. So you get the stock break, the tax break, the 1099, the showing the NUA, but you have immediately sold everything. So you've realized not only the ordinary income, but all the capital gains on that as well. So yeah, you can certainly do it. I always tell people, yes, these are the rules, these are the guidelines, this is how you do it, but do not just fill out the form and say NUA and mail it in, because you're looking for trouble. I would say, yes, get the form, fill it out, call the plan. Hey, I want to do NUA. Am I filling this out correctly? Yes. Hey, I want to do NUA. Do you process that? Obviously they do if it's on the form, but you ask that and say, yes. Typically people will say, oh, for sure, we'll do it, this is how we're going to do it. And they have their own process of how they do NUA. Usually people are on the ball, but I always recommend that folks call. Here's something. Go ahead.
I think I told you that, there's a couple of things like my office manager has been with me 14 years now, and she's just as good as anybody with rollovers, handling rollover calls with providers, and most of them are really on the ball, especially when you're dealing with a Fidelity or a big company like that.
Yeah.
But she knows, and you and I were talking about this earlier, if there's after-tax money in the plan, she asks these questions.
Yes.
Is there any after-tax money in the plan? Is there any NUA opportunity? And if they'll tell you if there is, and we reschedule the call to where I can be on the call, just so we make sure that the steps are being followed correctly, because at that point you're just listening to make sure that this person does in fact know what he or she is doing, and it's going to flow to the client correctly.
Right.
Yeah,
right,
but
right.
you're spot on there.
And I'll tell you what, you mentioned after tax. I don't want to get too deep in the weeds here, but there's some unique strategies within the NUA strategy. So if we go back to this example on this page right here, let's say hypothetically this person had $100,000 of after-tax money in their plan. They could use that 100 grand of after-tax contributions in the plan to buy down the basis.
Yeah, interesting.
So you can basically take what would be this example here with 100 grand of cost basis, take the after-tax money, buy it down to zero, do an NUA transaction, and all you're having to do is pay the capital gains on the appreciation.
Brilliant. And that is certainly something that the representative at Fidelity or whomever probably wouldn't pick up on.
Yeah, and they might not be either not aware of it. They might not be able to do it. That's why you just have to ask. This is what I want to do. This is my objective. Can you do this? Can you handle this? Here's one. And I've heard some big plans. Yes, most people know how to do this, but some big plans just are lost as to how this works. Unfortunately, another thing you can do, you can cherry pick the shares in your plan. Meaning, you can do NUA. I want to take out these shares because my cost basis is very low on these shares, but I want to do the rest of them. I just want to send to my IRA. So I just want to do the super low priced shares that I have. Now, not every plan will have that detail, that record keeping detail, but I do know of clients that do that. They have every share price of every purchase they ever made, and they're going to go ahead and pick these shares. And if the IRS ever asks, you're going to say, here's my proof. And this is why I'm only paying tax on this, despite what that 1099 says. And that'll work if they've got the documentation. So you can do those individual shares if you have the documentation to do so.
Now that's an interesting point, and I appreciate you saying that. What if you're underwater? What if you have a loss?
Well, then just anyway wouldn't work. There's no chance, there's no appreciation.
There's no
So
appreciation.
you're taking a distribution of the basis. Whether you do an NUA, whether you just take it out, you're looking at just the the basis is going to be taxable. I'll make one more point about this, and this is universal as far as NUA. So it's not one of those. It's not like if you have after tax or individual shares. This is how the process typically works. So if I take a distribution from my plan that's payable to me, and it's otherwise eligible to be rolled over, the plan is required to withhold 20%. They just have to. If you take a payment from your plan, they got to withhold 20%. There's no getting around it. It's the rules. So the question comes up, well, if I have NUA stock sent to me, how do I get that without 20% being withheld? Typically what happens is this: the plan will first send all the non-NUA cash, whatever, to an IRA. That's all gone. The only thing left in the plan is the NUA stock. No cash or nothing to withhold. Since that's all that's left in the plan, there's nothing there for them to withhold. They can't just carve off a bunch of shares and keep them. So that's how that's how you get around the 20% mandatory withholding when you have that distribution sent to you. That usually goes unnoticed, but that's typically how the plan will process the transaction.
That's really great. I just want to say to everybody who's watching, you saw me reaching over at one point, and I was just taking notes. I didn't want you to think that I was checking my text message or something. Taking notes about something Andy triggered. And I just want to remind you that Andy's probably doing the same thing, but you might see my eyes wander a bit, and there's 3 screens in front of me. So I'm just making sure that I got everything that you need. Okay, Andy, did you want to go over that that sheet?
You can bring it up. It's really basic, really easy. If you have it available there, we can just talk about just one final summary of how it works, and it's how the lights go on and little timeline. Like I said, real basic.
I'm just getting this there. All right, again, this will be on the website. So you should see something in front of you that has Ed Slott's logo and then NUA timeline triggering events. So raise your hand, please, if you're seeing that.
Not yet. Still got the PowerPoint on here.
Still got the PowerPoint?
Yeah.
Okay. Thank you. So let me just start and share all over again.
I bet it works now because I just see you and me now.
Okay. How about now? You got triggering events? Okay. Very good. Okay.
So that's it. Yeah, if you scroll down a little bit, or I don't know if you can maybe shrink it down a little bit to make it fit.
I can probably bring it down a bit.
There you go. So this is just what I talked about. I start at the blue line in the middle. That's the timeline of this person. And you can see they at 59.5, that arrow goes up. That's a trigger event that we talked about. This guy, Jim, goes for a couple of years. See, the light bulb is on. And then at 62.5, Jim takes a withdrawal. There's his family vacation. That he does not do NUA, and look at the light bulb. Very sad. So like I said, this is a very basic chart, but it's good for NUA. It's perfect. So a couple years later, or a year later, another green light, that green arrow up. It's age 63. Jim retires. So his NUA light is back on, and look at all those years. He's doing his thing. NUA is happy, ready to go. Age 72, Jim's first RMD is paid out. The light goes off, and if he doesn't do anything, you can see that bulb, that black arrow up. He loses NUA forever until he dies. But he's got all that time. Look at all those years in green where he could just talk to an advisor, figure out how to do NUA, take a distribution from the plan, save all kinds of tax. But poor Jim did not, I don't know if he acted properly in this, but that's a good overview of NUA, basic concept.
And don't forget, these bulbs all get shattered if you roll the whole thing over and don't even have this consideration. And Andy said in the beginning, it may not make sense. It just, we've gone through this time and time again where there's an NUA opportunity and we go through the numbers and it really doesn't make sense. But just because you have an NUA opportunity doesn't mean you have to do it. Right. But you should explore it just to make sure you've covered all the bases.
100%. Yep.
Because you can't go back and redo it, undo it. And I just can't say that enough. So even if it's small, it doesn't have to be $1 million. It doesn't have to be $800,000. If it's only $100,000, it still may make sense. You just got to take a look at it, and it doesn't cost anything but time, unless you're paying a fee for the time, and it may be worth it anyway.
There you go. That's it. Yeah, just have to ask, it's just ask a question. Do I want to do it? Does it make sense? And that gets back to the art of NUA and finding that tipping point. Where does it make sense? Where does it not make sense?
Exactly. Exactly.
Hmm.
All right. It is 7:35. We're just over an hour. I just want to open it up. I don't see any questions, but now's a good time to ask questions if you want to. Andy, do you have anything you want to say to wrap things up?
No, we've covered a lot of stuff. I'm sure people anybody that didn't know about NUA, their head might be swimming here a little bit, but it's not a crazy difficult concept. You know the lump sum, you know the trigger events, you know how you can activate stuff if you take a distribution. That's pretty much it, and you know how the money's got to move. Just be aware of it. That's it. Just be aware. It's not a one size fits all, but it's a great opportunity. Not many people are aware of it, advisors included. So you're definitely in the know now.
That's true. Roseanne said, extremely interesting presentation. Thank you, Andy and Mark. Thank you, Roseanne. Roseanne's always so kind. She always thanks us, and she's always got really interesting and good questions.
Good.
But hey, Andy, I want to thank you for your time. Again, I'm sorry we can't have a cold beer in Kansas City, but we'll have to do it soon at the next one. And this is really helpful. We'll have you back maybe before the year's out, if you can, to do another one. And you folks, there is another question. I'll get that in a second, but I want to remind you, when you log off for this webinar, my calendar is going to populate your screen. So if you have questions about this or any other issue that you'd like to review, you can schedule time for a consultation. Now, if you're a client, you can certainly schedule that time. If you already have a financial planning meeting or something like that scheduled, this will not be in place of that meeting because we're doing a lot of work behind the scenes. If you have already had a 50-minute complimentary consultation, send us an email and we'll schedule a time and we'll schedule the parameters around that time. But otherwise, feel free to use that calendar and I'll answer the questions I can for you. And we have another thanks, everybody. I appreciate that. Andy, I think that's what we have for tonight. I can't thank you enough, and I'll talk to you soon. And folks, I'll see you on Tuesday next week. And enjoy your weekend. Enjoy your Labor Day. Thanks, Andy.
Thanks, guys. We'll see you.
All right, take care. Bye-bye.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.